Hey, Kyler here. Our aim for this show is to leverage every opportunity that life throws at us. I hope you find value in today's show.
Kyler, I had a mentor tell me back a few years ago something that I will never forget. He said, I never invest in something I don't understand. The most simple advice you could possibly ever expect. But he told it to me, and I like instantly knew I am never going to forget that. And I'm going to tell every single person I ever meet and give financial or insurance guidance on that exact statement. Because you should never invest in something that is confusing and that you don't understand. And we hear it all the time when it comes to life insurance. Sometimes it's just communicated in such a way that it makes people more confused than when they started. Let's just cut through all the weeds. Let's bury the hatchet. Let's make it easy, not complicated. Just boil it down to a simple question. Do you have the right type of life insurance you need for this season for what your family needs? It's a simple question. And then today, on today's episode of the Leverage Life Show, Kyle and I are going to break it down very simply. Two distinct categories: when you need term, when you need something more permanent, because we hate the confusion. That's not how we operate. We love clarity so that you can actually put your dollars in something that makes sense for your family and it actually helps you accomplish your goals. We're not about solving problems that don't exist. But Kyler, let's walk through that episode today and jump right in on creating clarity over confusion.
Love it. Clarity is absolutely essential. And if you're ever talking with an advisor and you just feel confused about what's going on, just pump the brakes for a second and just take a step back and communicate with them and say, hey, I don't understand this. I'm confused on it. And if they still are just hard, they're pushy, they're trying to get you to do something you don't understand, that's a red flag. That is confusion. You don't ever want to make a decision on something that you're confused on. And we will literally lay that out in the first conversation with everybody we work with. If we're talking about something and it's just not hitting right or it's not landing the right way with them, like we tell them, I need you to have that transparency with me so we can maybe discuss this in a different way or just find a different way to talk about it. So we always have to figure out where is the clarity picture in everything that we're talking about, and especially with insurance, because the insurance industry, it can be very, very, very complex. But at the same time, it can actually be very simple. And that's really what we're talking about today. When we're looking at the differences between, hey, who should be getting a term policy, who should be getting a permanent policy, there's just a few different distinctions, and it's really based on life scenarios. When we look at somebody that has or they're needing a term policy, we've talked about this before in other episodes. These are typically going to be people that are younger. They're going to be people that don't have massive net worths. They have families they're growing, they're in their careers, and they have different obligations, such as a mortgage or such as paying for a kid's daycare. So there's different expenses that if somebody was to pass away, that would cause a lot of heavy lifting on maybe the other spouse, that they might not have the liquidity or the money to be able to actually continue the lifestyle that they actually are living right now. And so when you think of this, that kind of person or that avatar, if you will, that client profile, that's what a term policy is for. You're trying to replace those income like earning years the most when they need it the most. So if you're young, Cord and I are both young. If you're in your 30s, you're in your 40s, and you don't have a massive net worth yet, I should say, then you need to think about maybe I should have a term policy. And if you're younger, this is one of the most critical things to consider. It's dirt cheap when you're young. So you should not be pushing this off long time amounts of time. A lot of people, we hear them say, "Oh, we'll get that. We'll kick it down the road. I'll get it when I'm, making a little bit more or something like that." But the reality is that we're always getting older. The older you get, then it's going to be more expensive because you're getting closer theoretically to the time when you're going to pass away, just the older you get. And so you've always got to be thinking, hey, it's probably better to get a term policy younger when you're super healthy, you're fit, you need that money if somebody passes away, and it's going to be serving you really, really well. So that's what we're really looking at from somebody that would benefit from a term policy. So it's really not too complicated. On the other side, a permanent policy, there's a few different specific reasons that we would recommend something like that. But one of them being too is if you just know you want something permanent for the rest of your life, then if that's just your mindset and you have the money to do that, then go for it. That's totally cool,
Mhm.
right? If you know you want to have this the rest of your life, that's a valid reason that somebody will want to get something. Many times, though, if you're looking at a permanent policy, it's obviously going to be more expensive because it's for your entire life. Now, when you get into permanent policies, you've got different ones just like term policies, but you've got different IULs, index universal life policies. You've got whole life policies, and all of any kind of product, if you will, with an insurance, they're going to come with all these little bells and whistles and riders you can add on this and that. But just very simply, somebody that would possibly want to get a permanent policy in our context of this show is somebody that maybe has a larger net worth. If you have over 2 million, over 5 million, $10 million, then your problems in that stage of your life are going to be completely different compared to when you're in your 30s and 40s. So most people that are maybe like 55 to 60, like you've already gone through your massive career earning years, then you've accumulated a lot, and you're
Mhm.
maybe looking at that next step to retirement, whether you're, you know, retiring in the next 5, 10 years if you're like 55. And so your problems that exist right now for those people are different. We're looking at people that possibly have estate tax problems, whether that's going to be a federal or state issue. You've got people that are going to have businesses that they're needing to sell. So buy sell agreements. You're looking at just a ton of different, just generational wealth transfer types of problems that do start to come up and come into play when you get into those pre-retiree retirement ages. And so permanent policies will serve a very specific or they will solve a very specific problem in those years specifically. And so on this show, we've talked about people that have liquidity issues, and specifically in the context of estate planning. That is something that a permanent policy will be able to do if you're going to have a problem with estate taxes in the future. And so I want to make that very clear that we're not trying to solve a problem that doesn't exist. We have talked about that ad nauseum in this podcast. And so if you're somebody that's going to have an estate tax issue, then you need the liquidity in order to pay those estate taxes so your family doesn't have to sell off real estate. They don't have to sell the business and do a forced sale
Mhm.
just so they can pay the government. That's just going to put a pit in your stomach if that occurs. And especially for families knowing that they could have done something to avoid that. And we've seen it happen. And so we don't want that to be the case for you. And so, just kind of to recap, we're looking at term policies for people that are going to be in their primary income earning years. They've got a mortgage, they've got kids, they're raising a family. They have things that are really going to need to be paid off in order for the family to continue on with the same lifestyle. A permanent policy is going to be for somebody that's maybe a little bit, they just want a permanent policy, like I said, or
Mhm.
if they need to solve a very specific problem, whether it's liquidity or a buy sell agreement, or they want to make sure that they do have a solid generational wealth transfer plan in place. So Court, I would kind of say those are going to be kind of like your two different client profiles, if you will, for looking at term versus a permanent policy.
It just makes it so much more simple, especially that, 2 million kind of threshold there once you start to get some different problems in the estate. And that's why we want to give you exactly how we break down our decision making process. We tell people to avoid a few different things and instead do something different. So we're going to put this table either on the screen or in the description. You'll be able to see it. But here's what we want people to avoid whenever we're talking with them. We want them to avoid complicated index universal life and whole life permanent structures if their net worth is under $2 million. Why? It just doesn't really make a lot of sense yet. You need that once you cross a certain threshold. So we try and make it as simple as possible. We also want you to avoid waiting to get a term policy. Like Kyler said, it's dirt cheap. You literally have no excuse not to have one. You need it. It's so simple. A lot cheaper when you're younger too. You also want to avoid overly pushy agents and advisors. I don't think I have to go into the reason as to why you should avoid overly pushy agents and advisors. Feels like used car salesman, wipe that off my shoulders or something. And the last thing we want you to avoid is just trying to figure it out yourself. Talk to someone that can help. So avoid those four things. Avoid, these complicated permanent life structures if your net worth it doesn't qualify for it. If your net worth doesn't make sense and you don't need it. We want you to avoid waiting to get the policy you need. We also want you to avoid overly pushy agents and advisors, and we want you to avoid figuring it out yourself. Just don't DIY it. But instead, here's what we want you to do. Instead, we want you to consider the pros of permanent life insurance if your net worth is above 2 million. And then, like Kyler described, what problem do you need to solve and how can a permanent life policy actually solve it? It makes so much sense at that point, and it gets a lot less complicated. We also want you to but do this instead. We want you to get plenty of term coverage to cover the liabilities. I'm talking outstanding debts. I'm talking income replacement. I'm talking mortgages. Those liabilities are going to be really tough to cover if you don't have a life policy in place and the worst of the worst happens. Best case, you don't need it. Good. You still have it. We also want you to instead talk to advisors, talk to agents who seek to understand first. Now, why do I say that? Seek to understand your goals first. That changes the whole conversation. It's less about pushy, pushy, pushy. You need this, buy it, sign on the dotted line, and more of a take a step back. Hey, why do we need this? What goals are you trying to accomplish over the next 5 to 10 years? What are your hopes? What's the goal for the business? What's the goal for your family? Then we're fine tuning and actually putting things in place that are needed. So talk to people who seek to understand first. And then loop in people you like and trust. It's as simple as that. Talk to Joe Schmo down the street if you like him and you trust him, and ask him what he did. Who did he talk to? Who does he trust if you don't know anyone? It's as simple as that. Trying to make it very clear to avoid certain behaviors and instead do these behaviors instead. And I want to talk very specifically about two different behaviors that you should avoid in this. And I'll be very, very brief. But first, waiting. Waiting. We see it all the time. We hear it all the time on conversations. Oh, I've got this thing I have to figure out with my estate first. Oh, I have this business problem I have to figure out first. Oh, I have this sports event that I have to take my son to. Oh, I have this fill in the blank. Something is always on the plate. And believe it or not, you will never get less busy. Do you know that? I've never figured out how to get less busy sometimes. You can take stuff off the calendar, but there's always problems and things that need to be taken care of that require our attention. So don't use that as an excuse to wait to get life insurance. It's the worst excuse you could possibly put in there. I felt it. Kyler's felt it. Our clients feel it. Don't wait. Consider it a matter of stewardship right now. And then the second behavior is the overly pushy agent. I just want to double down on that because the right agent and the right advisor will connect with you on a deeper level than just trying to sell you a product. That is so crucial when you're talking about a holistic perspective of your portfolio and your estate, because we like to look at everything and we want to make sure you're taken care of. We want to lead with care. That is our biggest posture. We're about stewarding legacies here at the Leverage Life Show, not just pushing products. That's what we're all about. So that's what you get when you talk with us. Kyler, I cut you off. Go ahead.
No, you're good. I was just gonna say that's perfect. I love those two behaviors and looking at just kind of the things that everything you're talking about here. And so I was just gonna say, Cord, for episode today, like we said, it's really just very simple. It's really not too complicated. And I talked about the different client profiles, if you will, for term versus permanent, and just to kind of land the plane for today in this episode, I'm just gonna talk through a couple specific examples, just like I do on every episode, and then Cord, after that, I'll let you um, I'll land the plane here, and then you can pull into and taxi and park it. So for the end of the episode, but let's talk about somebody that has a term policy. So if this is you or somebody you relate to this specifically, then I want you to consider, hey, I should probably be getting a term policy if I don't. Okay, so this person is going to be 38 years old. They are married, they have 2 kids, they have good income, they have a mortgage, okay? You can see the pattern here. It's very, very specific to a lot of, young families, okay? If that is someone like you and you're building your retirement account and your employer is matching it, like, you're doing all these things, you're doing all the right things, but you know that if something happened to you as the primary breadwinner, that your spouse would have a problem. So here's the things I want you to think about. Number one, how much is your mortgage? How much do you have left on that debt? That's going to be a good starting point to say, hey, if I've got, $350,000 left on my mortgage, then I probably should get at least $350,000 worth of term life insurance. Okay. It doesn't stop there though. Let's start adding these up. So you know you've got that. Let's say, let's look at your living expenses. What are your monthly living expenses? Now, we always like to have an emergency fund, but I don't want you to have to tap into that if you don't have to. If you can leverage a life insurance policy to essentially do an income replacement for a certain amount of, whether it be months or years, we typically are going to recommend at least a year, if not more, because we want to make sure that you can essentially get through the hard grieving process timeline. And so that way you can just make sure that you can kind of get through that. Those are, if you haven't lived through that, that's going to be something that I hope nobody lives through, obviously, but those are real. And it's going to be significantly harder and a burden if you're having to carry the weight
Mhm.
of having to continue on that lifestyle. So that is going to be client profile number one. If that fits you, then add the stuff up. Hey, what do you feel like you need and what do you want to make sure that your spouse has to make sure that they continue that lifestyle and they can continue on after you're gone? Okay, that's number one. Number two, mentioned this earlier. This person is, let's say, 54 years old. You have built a solid retirement account. You're looking into retirement years, you're retiree. Now, you might have a business that you own. You might have different real estate rental properties that you have acquired over the year that's spitting off, cash flow to you. That's fantastic. And let's say that you have a net worth north of 5 million, $10 million. Your problems are vastly different compared to
Mhm.
person A. Okay. Now we're looking at generational wealth transfer, retirement. We're thinking about maybe, um, if I ever, this is like years down the road, maybe 20, 25, 30 years. Okay. Life expectancy is continue to extend for everybody, of course, with modern medicine. But let's say you're thinking about long term care. Okay. So there's different things to consider here as well. And so those problems that you're thinking about can be solved a lot of times through a permanent policy. Now, I want to take it the next step further. We've talked about this as well on other episodes, but a permanent policy, you need to look at who owns it. Is it owned in a trust? Okay, so there's different things that you can do to make things more efficient for generational wealth transfer. So if that is your client profile, you match that specifically, then maybe be looking into a permanent policy and we can dive
Mhm.
into all the different specifics of things that the bells and whistles you can add on to these things and how it's owned and structured, all those things. But those two distinctions for today is really what we're looking at, and we don't want to overcomplicate things that don't need to be complicated. So clarity is king in this in
Mhm.
this uh, in this business of insurance for sure.
And we'll land the plane very clear. Just give you a couple action steps here to take away from today's episode. One, if you don't have any term or permanent life insurance coverage, you probably need it. It's as simple as that. Review our decision making process of avoid instead that we've dropped in this episode and review it. If you don't have any, get it. Shoot us a message 479-396-3528 and we'll get you squared away. Secondly, this is what we see very common happen. You have something, but you've outgrown it. See it happen all the time. You have something, you've outgrown it. Then it needs to be reviewed and probably enhanced. Also, shoot us a text 479-396-3528. Shoot us a text and just say life, LIFE, for life insurance. We all know we need it. I don't want you to have outgrown what you currently have, and we want you to have something at the very least. So that's it for today's episode on the Leveraged Life Show. Once again, this is Cord and Kyler Offenbacher, two brothers that are coming at you live every single Friday, trying to leverage every opportunity that life throws at us for maximum impact. So we'll see you next Friday.